Hello guys, if you know you want to stop blowing your synthetic indices trading accounts or your other form of trading accounts, I advise that you watch this video till the very end. And before you do so, I'd like to plead with you to hit on the like button and the subscribe button. Thank you for doing that. So today I'm going to be talking about something that I have titled Points of Interest. Point of interest. Now, what's point of interest? Now, I like to use this analogy. If you want to buy anything, the area in which you go to buy that thing, maybe probably for the best possible price, would be the point of interest in which you would get that particular stuff to buy. The same way, if you're a seller, the best possible area where you have higher demand for your products would be the point in which you'll be interested in going to sell that product. So if we are to take this back to relate this to our trading, the point of interest is the best possible price on your price chart or your trading chart, in which if you decide to buy or sell the market, then you have the highest probability of making profit. So I'll try to take that again. If you have a bullish market trend and you have decided that you want to buy in that market, the best point on the market chart in which you would increase your probability of making profits will be the point of interest or your point of interest. Now, for a bullish market, we said earlier that when we say a bullish market, we mean a market that is in an uptrend, that the market structure gives us a series of consecutive higher highs and higher lows. For a bullish market, our point of interest will be located at the higher lows of the market. Now, what does that mean? It means if I have this as an example of a bullish market, I have my high, I have higher high, I have higher high, higher low, then I have another higher high, and of course, higher low. My point of interest in this market would be these areas of the chart. So I have the higher low, the higher low, the higher low. Now, why are these places referred to as my point of interest? Because if these lines simply represent price patterns or price points on the chart, it means that each time the price comes down, then we have a low price in which we can possibly buy the market. And of course, we know that the law of supply and demand simply says that the higher the price, the lower would be the demand, and the lower the price, the higher would be the demand. So buyers generally want to buy at a very low price, while sellers want to sell at a very high price. So looking at this bullish trend, the best possible places in which we would buy and want to make maximum profit or be profitable would be at the higher lows of the market. So it would be very, very, very bad if maybe, like some people always do, the market has gotten to this point, then we decide to press buy. But the market has gotten to this point, we decide to press buy. Even when the market is at the middle, it is not advisable to press buy because it can reverse anytime. Why? Because we already understand that the market is in an uptrend. So that's why market structure also is very important when applying this rule or picking our points of interest. So if you're not conversant with market structure, I already have a video that I've done before concerning market structure. You can quickly check that out to brush yourself up. So I'll go over it again. For a bullish market, our point of interest are located at the higher lows of the market. So let's look at for a bearish or a downtrending market. Now, for a downtrending market, our point of interest, we'll say they are the price levels at which, if we sell the market, we'll have a high probability of making profits. Now, where are these points on our price charts? These points on our price chart, because we said also that a bearish market is made up of a series of lower highs and lower lows. So we have a lower high, a lower low, a lower high, a lower low. Then I can add another lower high, and then another lower low. Now this market, because the structure is a downward market, or a downtrending market, we are expected to look for sell positions. Now, just like I said, sellers want to always sell at what? At a high price. So we say that our point of interest in a downtrending market will be the lower highs on our price chart. So it will not be advisable to, maybe because you are scared of missing out after your analysis, you saw that the market price had already moved to a point around this place, then you click on sell. That's because the price can reverse anytime, even without getting to your predicted destination. So it will be advisable to always look for our sales at this point in the price chart, our lower highs, lower highs, lower highs. And of course, this is what? A down trending market. So we're going to look at this now on our price chart. Now, this is volatility 25. Volatility 25. Now, on this volatility 25, luckily for us, we have an uptrend here. This is a higher high, higher high, a high, higher high, higher high, higher high. And of course, we have what? Our what? Higher low, higher low, higher low. And of course, the market has just taken out the most recent higher low. But if we were to buy this market, all we needed to do would have been to see that once this market left this point, all we needed to do would be to wait for the market to come down before engaging our buys. And of course, the market kept going, came down. We wait for this pullback to the higher low for us to what? Engage our buy. Now, just like I've said, these are points of interest. I'll be dropping another video that talks about the key point of interest. Now, the key point of interest will now be what? The things in which we look out for to see if we see those particular things, maybe like our order block, our imbalance. So those are the things that will encourage us to wait for price or to engage in either selling or buying the market at that particular higher low or lower highs as for the sell market. So let's quickly look at the other parts that we talked about, which is the downtrending market. Now we can see that we have a beautiful downtrending market here. Now the points of interest, now we say it's a downtrend because it's made up of a series of, if I say this is a high, this is a lower low, a lower high, lower low, lower high, lower low, lower high, and as we can see, that's continued. Now our points of interest will be at the lower highs. Why? Because these are the highest prices on the price chart. So people want to sell at the highest possible price. Why they want to buy at the lowest possible price. So in other words, at the lower highs, while it is expected that we have a lot of sellers there. And remember that sellers determine the direction of a downtrending market. So it will be wise to engage in selling the market at the point where we have a lot of sellers. In other words, we have a lot of suppliers, which will push the market and make it favorable in our direction. As a result, would increase our probability of making profits. So our points of interest in the downtrending market, where we are expected to engage the market, will be when the market comes down. Imagine entering this market somewhere here. Now you'll be lucky. Yes, it still came down, you make profit, but you can see that it turned and went back. So if you enter here, it would have come back to hit your stop loss, which would be around this place. So our point of interest will be the market coming down. When it goes back up, that's when we would engage the market. It comes down, goes back up, we engage the market at the lower highs. Now I know somebody will be asking, so what of when the market is not in an uptrend or a downtrend? If it's a consolidating market. Now I think I've talked about that in my previous video. A consolidating market is a market that moves between support and resistance. So if this is what a resistance, this is support, consolidating market moves between support and resistance. Support, resistance, then support, back to support. It goes back to the resistance. It comes back to support, goes back up to the resistance. So when this continues, we say we have what? A consolidating or ranging market. Now for this case, how do we engage in these markets? Now, when price level is at the middle, it is advisable to stay away from consolidating markets. But when the price level is at the resistance point, then we say that that becomes our point of interest to sell the market. So the resistance would be what our point of interest to sell the market. While when the price comes to the support level of the consolidating market, we say that this is at our price level towards to buy the market. So when it comes back towards our support level, we engage in buying the market. So let's see if we can represent that on the chart. This video is going to be very short. I wouldn't want to take much of your time. Good. Now, we have a perfect example here of a resistance level and what a support level. So what do? When the market gets to this support point, we engage in buying the market. And when it gets to this point, we engage in selling the market. Now, this is a perfect example of why I told us that it is not advisable when the market has gotten to a certain point to engage in selling the market. So imagine if you had tried to sell this market because you have FOMO, fear of missing out. The market had gotten, you decide to click on your sell. You can see that the market went back up, even if it were coming from a resistance level. Now, like I said, guys, if you are able to apply this principle or add it to some of the rules when it has as regards to your trading, it will be very difficult to blow your account. That's each time you try to, you make it a habit of buying the market at the higher lows of the market structure and selling it at the lower highs of the market structure. So I'll repeat that. Our points of interest in every market, whether you're trading Forex or synthetic indices, for a bullish market, our points of interest are at the higher lows, while for a bearish market, our points of interest are at the lower highs. So guys, I hope this video has been of value to you, and if yes, I'd like to plead with you to please subscribe to my channel, as I'll be dropping more videos and more tips on how to profitably trade the market. So cheers.